Imagine investing in something you can see, touch, and transform. A physical asset that grows in value and generates income. Welcome to the world of real estate investing. Unlike other investments, real estate offers the allure of tangible ownership and the potential to shape your wealth with every decision, from choosing the right property to leveraging tax advantages. Today, we'll explore the multifaceted world of real estate investments, covering everything from rental income and property appreciation to the different paths you can take, whether hands-on or hands-off. Let's dive into this timeless and powerful investment choice and see how real estate can anchor your financial journey. Real estate is a unique asset, offering a variety of ways to generate returns. For one, it provides capital appreciation. Over time, the value of real estate typically increases, driven by factors like population growth, urban expansion, and economic development. If you invest in areas that are emerging or seeing significant growth, the potential for appreciation can be substantial. Unlike stocks, which are intangible and can be volatile, real estate's physical nature makes it a real asset, which many investors find reassuring. Another appeal is rental income. Unlike investments that rely solely on appreciation, real estate can generate a steady, passive income stream through renting. Rental income not only diversifies your revenue, but also acts as a hedge against inflation, as rent can be adjusted over time. For those who prefer regular income, owning rental properties transforms real estate into an income-generating asset, providing stability even when other markets fluctuate. Real estate also offers leverage opportunities. Property investors can use their real estate assets as collateral to secure additional financing. This leverage allows them to scale their investments and increase potential returns. However, this strategy requires caution, as borrowing also increases the risk. Real estate offers two primary paths: direct and indirect investing, each with its own advantages and considerations. Direct real estate investing. This approach involves purchasing physical property, whether a residential home, commercial building, or plot of land. Direct investing gives you full control over the property, allowing you to make decisions on renovations, tenant selection, and overall management. Some investors enjoy the tangible nature of direct investing, where they can personally influence a property's value by enhancing it or managing it well. However, direct investing is time-intensive, requiring hands-on involvement, from managing tenants to maintaining the property. Additionally, real estate is not very liquid. Converting it to cash can be slow, especially in down markets. Indirect real estate investing. For those who prefer less direct involvement, indirect options like real estate investment trusts, REITs, or real estate mutual funds offer exposure to real estate markets without the challenges of property management. With REITs, investors purchase shares in companies that own, manage, or finance income-producing properties. REITs trade on major stock exchanges, making them more liquid and accessible. They provide the benefits of diversification, professional management, and the ability to invest with smaller amounts of capital. However, REIT investors surrender some control, relying on the REIT's management team to make property-related decisions. Choosing between direct and indirect investing depends on your investment goals, risk tolerance, and desire for involvement. Direct investing offers hands-on control, but requires substantial time and capital, while indirect investing provides easy access and liquidity, with less responsibility for day-to-day management. Real estate investing offers various strategies, each suited to different types of investors and market conditions. Buy and hold for rental income. This strategy involves purchasing property with the intent of holding it long-term while earning rental income. It's ideal for those looking for a consistent income stream. By carefully selecting properties in desirable locations, investors can enjoy regular rent payments that cover costs and generate profit. This approach also allows for property appreciation over time, building wealth as the asset's value increases. Flipping properties. For those with a higher risk tolerance and a knack for property improvement, flipping involves buying properties, renovating them, and selling them for a profit. This strategy requires market knowledge, as successful flipping depends on accurately gauging renovation costs and the resale value. While potentially profitable, flipping is also labor-intensive and carries risk, as property values can be volatile. Real estate crowdfunding. This newer approach allows multiple investors to pool their money to fund property development or purchase. Crowdfunding platforms provide opportunities for investing in larger commercial projects with minimal upfront capital. While this approach offers easy access to real estate, it's also riskier, as the project's success depends on the developers and managers involved. REITs provide a way to invest in real estate without the hassles of property management. They are companies that own or finance income-producing real estate in a range of sectors, from residential apartments and office buildings to healthcare facilities and shopping centers. REITs are required by law to pay out 90% of their taxable income as dividends, making them attractive to income-focused investors. One of the biggest advantages of REITs is their liquidity. Unlike physical property, which can take months to sell, REIT shares can be bought and sold on major stock exchanges. This flexibility allows investors to react quickly to market conditions. REITs also offer diversification, as they often hold multiple properties across various locations and sectors, spreading risk. However, REITs are subject to market conditions and interest rates, which can affect their value and the dividends they pay. Furthermore, because they distribute most of their income, REITs often rely on debt to finance growth, introducing an element of risk. For investors seeking income and exposure to real estate with liquidity, REITs can be a compelling option. Real estate markets move in cycles, with each phase presenting unique challenges and opportunities. Understanding these cycles, expansion, peak, contraction, and trough, is essential for timing investments strategically. Expansion. In this phase, the economy is growing, employment is strong, and demand for property rises. Vacancy rates decrease, and rental rates tend to increase. This phase is often a good time to buy property, as rising values and rents can provide strong returns. Peak. The peak phase is marked by high property values and low vacancy rates. However, growth begins to slow as prices reach their highest levels. Investors need to tread carefully, as the peak often signals that a market correction may be coming. This phase may be ideal for selling properties at top value. Contraction. During contraction, economic conditions soften, and demand for real estate decreases. Property values may stagnate or decline, and vacancy rates rise. For well-prepared investors, this phase can offer opportunities to purchase properties at lower prices. Trough. The trough marks the bottom of the market cycle, where prices and demand stabilize. This phase presents a buying opportunity for investors looking to purchase assets at low prices before the next expansion phase begins. By aligning investment strategies with these cycles, investors can make informed decisions about when to buy, hold, or sell properties, helping them maximize returns while managing risk. Securing the right financing is key to successful real estate investing. Each financing option has unique characteristics, from the terms and interest rates to the ease of access. Traditional mortgages. The most common financing option, mortgages offer low interest rates and longer terms, making them ideal for long-term property investments. However, obtaining a mortgage requires a strong credit score, steady income, and a down payment. Hard money loans. Hard money loans are provided by private investors and are often used for short-term projects like flipping. These loans offer fast approval, but come with higher interest rates and shorter repayment terms. They are best suited for experienced investors who need quick capital. Government-backed loans. Programs like those offered by the Federal Housing Administration, FHA, provide lower down payment options and are accessible to a broader range of investors. These loans have restrictions, such as owner occupancy requirements, but can be a great option for first-time investors in the rental market. Bridge loans. For investors waiting on the sale of another property or approval of long-term financing, bridge loans offer temporary funding. These short-term loans help investors secure a property quickly, but they carry higher interest rates and require clear exit strategies. Effective real estate investing requires a solid understanding of market conditions. Key factors to consider include local economy. A strong economy with high employment and industry diversity attracts demand for real estate. Growing economies tend to support rising property values and rental rates. Demographics. Shifts in population trends, such as young professionals moving into urban centers or retirees seeking quiet communities, impact demand for specific types of real estate. Supply and infrastructure. Evaluating new development projects, zoning laws, and infrastructure improvements can reveal insights into future market conditions. Limited supply and improved infrastructure often lead to property value increases. Neighborhood analysis. Every neighborhood has unique factors, such as crime rates, school quality, and amenities, that affect property values. Visiting areas, engaging with local professionals, and reviewing community resources provide valuable context for investment decisions. Real estate is a dynamic investment arena, offering diverse opportunities that cater to various goals, risk tolerances, and involvement levels. Whether through direct property ownership or indirect investments like REITs, real estate allows investors to build wealth through appreciation, rental income, and strategic leverage. Understanding the cycles of the market, choosing the right financing, and analyzing local conditions are essential to navigating this landscape successfully. With careful planning, knowledge, and a strategic approach, real estate can serve as a powerful asset, generating income, providing stability, and enhancing your portfolio for the long term. For those ready to embark on the journey, real estate offers a path to financial growth anchored by the enduring value of tangible assets.